Hi, my name's Eku Malcolm, and the question that I have for you today is a question that is very common because everyone likes to own a house. And that question is, should I go with mortgage insurance through the bank or should I go with a personal life insurance policy? It's a great question. Now, they each have different values to it, but there's a couple things that you have to think about when you're looking at a life insurance policy as opposed to mortgage insurance. The first thing you have to look about is when it's going to be underwritten. Now, that's a big word and I don't want to confuse you. So let's talk about that. When you get a life insurance policy, one of the factors in choosing that life insurance policy is we have to go through a questionnaire. And that questionnaire is going to illustrate things like, are you a smoker? Do you have a tendency to participate in hazardous sports like skydiving? Things like that. Things that are going to establish your ability to persevere, to live on, so to speak. So, with underwriting with a mortgage insurance policy, that policy is underwritten at death, at the time of claim. What that means is that your bank, or whoever you have mortgage insurance through, is actually going to go through your entire medical history and potentially find a reason not to give you that policy. Now that's pretty scary. You've invested time, you've invested money throughout the years, and the bank might decide, you know what, I'm not interested. We're not going to give you the payout. Now, a life insurance policy, on the other hand, is underwritten at the time of application. So we submit the application. Before you even approved, we're going to go through the questionnaire. We're going to maybe take a medical, take a blood test. And at that point, then if you're approved, then you're approved. The way I want you to look at a life insurance policy as opposed to a mortgage insurance policy is a life insurance policy is a moment in time. It's a snapshot. It'll never change. You might have a flexible variable on it saying, you know what, if you need you're going to be rated at this much, but then if you lose some weight, in the first year, we'll have the ability to change it. But after that first year, that's it. Unfortunately, or fortunately, depending on your situation, that life insurance policy is a snapshot in time. So what that means is that it's underwritten, you get approved, and that's going to maintain all the way until you die, or until you choose to cancel the policy. Which brings me to my second point. Now, when we're looking at mortgage versus a life insurance policy, you're looking at something with mortgage insurance that is going to renew every time that you renew your mortgage. The problem with that, however, is that insurance gets more expensive as you get older. It's common sense, right? As you get older, you're getting closer to dying. So, insurance is going to get more expensive. But if you're renewing your insurance policy, your mortgage insurance policy, every 5 years or every 4 years, however you're renewing your mortgage, that means that you're constantly renewing your insurance at the rates that are going to be more expensive than if you were to get it today. So, as with a life insurance policy, the benefit of that is that you actually have the opportunity to buy something today and lock that in for 10 years, for 20 years, at that same rate. So that ensures that, you know what, even down the line, you know what, you're 20 years older, you're still going to be paying the same insurance that you got today at 25, 30, however old you are, as opposed to what you would be paying every 5 years going forward with a mortgage insurance policy. So those are two of the important things. The third thing and most important thing about talking about life insurance versus a mortgage insurance is thinking about how it affects you personally. When you're working with mortgage insurance, the bank is a beneficiary, meaning that you don't own the policy. Unfortunately, what that means is that say you die tomorrow and your wife decides that, or your husband or wife decides that they love their house, they make good money, they don't need to pay off the mortgage. They don't have access to any of that income. So the bank is going to take possession of that. Whereas if you own a life insurance policy, your beneficiary owns that money. And it transfers to them tax-free. So they might say, hey, I make great money. I'm not really worried about paying my mortgage. It's a low payment. It's a good rate. So instead, I'm going to use that money for something else. Maybe it's a renovation. Maybe it's a new car. Maybe it's a trip around the world. Whatever it is, it's freedom. And so that is something that is really, really important. When you're looking at those three steps, when you're thinking about mortgage insurance, who do you want to own the policy? The bank or yourself? What price do you want to be paying? Do you want it to be constantly going up as you get older or locked in for the next 10 or 20 years? And more importantly, as you get up to that number one option that we talked about, is thinking about how is mortgage insurance different than life insurance? So when you're ready to talk about if you want to go with mortgage insurance or if you want to go with life insurance, then give me a call, 204-955-2879, or visit my website, ekumalcolm.com. I'd love to interview with you for a candidate for that position as your financial advisor. When you're ready, give me a shout. I look forward to working with you.